our COBT viewers and listeners, it's Maynard, Mike, and Jeff with a really exciting discussion that we've been looking forward to. We're going to talk today to Obinna Isiadinso. He's the data centers global sector lead at the IFC. If you don't know the IFC, it's the private financing arm of the World Bank. The reason we got to know Obinna and sought him out was he's the author of the Global Data Center Hub Substack, which is really quite good. I caught up with him and just told him, look, we appreciate reading it. He's keeping up with data centers all around the world. And I think the data center trend, although we know it as a US trend for sure, it's really a global trend, and Obinna brings visibility to all that. So let me just stop here and say, Obinna, we're delighted to have you join. We can't wait for this conversation.
Well, thanks so much for having me, and it's really a pleasure to be here with you and your colleagues and your audience, and really appreciate what you guys are doing in the energy space, which is a big part of the data center value chain today.
Fantastic. Well, Mike, before we jump in with Obinna, the market's always something happening. What would you tell us today?
Yeah, Maynard, it's a pretty interesting market so far this week, but for today's COBT, we're going to focus on a couple things. First of all, the FOMC meeting that's going to be happening on Wednesday, the OPEC Plus meeting that's going to be happening this weekend, sort of the Argentina legislative election results, how that has affected markets. We've got a bunch of AI and tech Q3 results here on Wednesday and Thursday. We'll talk a little bit about that. Oil majors and refiners are going to be reporting results, Q3 results later this week, and we'll talk about some broad-based energy results, and also Cameco's nuclear deal that they struck with the U.S. government on Tuesday. As far as the bond market, the 10-year continues to be stuck at the 4% level. Wednesday's FOMC meeting, most people expect there's going to be a quarter rate cut, and another quarter rate cut is expected at the December FOMC meeting. So Chairman Powell's press conference on Wednesday is going to be really important. So there could be a lot of volatility later tomorrow afternoon. As far as the oil market, WTI oil price is trading at around $60 a barrel. That's trading at about $1.50 per barrel this week. And I'd say what's going on here is that the 2026 oil supply surplus is still the biggest focus for oil traders, specifically the amount of oil surplus for 2026. Is it going to be 1 million barrels a day, or is it going to be higher towards the IEA estimates? We don't think it's going to be near there. We think it's going to be closer to the bottom end of that range. Oil rallied last week on Russian oil sanctions. This week, oil market's cooling off, and it's waiting for the OPEC's meeting at the end of this week, to see what their current assessment is of the markets. And right now, consensus expects that OPEC's going to increase another 137,000 barrels a day at this meeting, just like they did in the October increase. Bottom line, even with Russian oil sanctions and OPEC production increases, we still see 2026 as a tale of two halves. We've been talking about this concept for the last month or two. And that's with the first half of 26 being pretty choppy, a little bit challenging, with second half of 26 and into 27 being much more constructive for oil markets, and not for just 1 year, but for a handful of years. As far as what we saw as the biggest global market news, in the last week or so, it's Javier Milei's party pulled off a huge victory in Argentina over the weekend, which led to a surge in bonds. Yields plunged to their lowest levels this year. The peso appreciated. In the Argentina Merval equity market surged by about 20%. Two of the biggest winners on that surge were Vista and YPF, which were both up about 20%. As far as broader equity markets, U.S. equity markets, the S&P 500 continues to post new all-time highs this week, and it's due to optimism of a U.S.-China trade deal. Obviously, Trump is over in the Asian region right now, and he's striking deals all over the place. This week, equity investors will be totally focused on AI and big tech Q3 earnings and their newest spending estimates on data center build-out. Google, Meta, Microsoft report Wednesday, Apple, Amazon report Thursday, and 1 to 2 weeks from now, we're going to have AMD, CoreWeave, Dell, NVIDIA, Qualcomm, and a host of other guys. So expect a lot of volatility, especially equity volatility, this week and the next 2 weeks, because these AI and big tech names make up 35% of the S&P 500 market cap. As far as Q3 earnings for energy, 2026 capital spending will be in focus as oil majors and E&Ps begin reporting this week and into next week. European and U.S. oil majors will be in focus this week with Chevron, Shell, Total, and Exxon all reporting along with a handful of U.S. refiners, including PBS and PSX. Gas E&Ps, oil E&Ps, midstream, pressure pumpers, offshore rig companies, power infrastructure companies, and electric utility companies will be reporting towards the end of this week as well. So it's going to be really, really broad-based. And the last thing we want to finish up with is this deal today with Cameco and Brookfield Asset Management. They signed an $80 billion deal with the U.S. government to accelerate deployment of Westinghouse's nuclear reactors. Cameco is up 25% this year, and this has been a big priority for the Trump administration, and we are seeing deals done. The market took this really well, so this is going to be interesting to talk with Obinna today, see what he thinks about this, and maybe talk about his thoughts about electricity in general. So we're really looking forward to it, Maynard, so we'll hand it back to you.
All right, great. Jeff, anything you'd add before we jump in with Obinna?
Yeah, just a couple things to kind of set the stage as we start to dive into the data center discussion. Just, particularly in and around hyperscalers, their financials, and the implications for all the investments that they're making. It's just a fascinating change in capital intensity for some of our largest and most successful companies. If you just look at, last year, I'll use Meta, Microsoft, and Google. It's just cleaner whenever you exclude Amazon from that because of the retail business. But those companies, generated about mid-30s return on equity, just under 30% return on invested capital. So big, successful companies generating really high returns. And it's just fascinating pivot and increase in the capital expenditure profile. If you go back to the 2022, 2023 timeframe, all three of the companies were spending, between 25 and 30-ish billion dollars a year of capex apiece. You fast forward to 2027, the three of those companies each, it rounds to $100 billion apiece. A really fascinating change in the underlying, asset profile. If you take just the assets less the cash on the balance sheet, you go back a decade, and compared to today, the range of assets has gone from roughly kind of $30 to $90 billion of assets on the balance sheet, up 5 to 7-fold. As you go over the 10-year period. Even more fascinating when you look at PP&E, where that capex number is going to translate into PP&E, where the profile is up 6 to 20 times over the last 10 years. In round numbers, these companies have about $150 billion a piece of PP&E on the balance sheet. And just kind of going back to, they're going to be spending about $100 billion a piece in capex. So really fascinating change in capital intensity for some of the really highest returning companies in the market.
Awesome. Well, Obinna, this topic is about as hot as it gets. One place to start is, I think we're delighted to connect with you for so many reasons. But one of the organizations over the last handful of years that always comes up that we haven't really connected with, honestly, is the World Bank. And so the fact that the IFC is part of the World Bank and you're leading private sector financing globally, I think the IFC is a fun place to start, just to refresh all our memories about what it does, how it's connected, what you're trying to accomplish. Would you mind starting there? I know your career is a long career in finance and investing before you went to the IFC, but if you kind of weave your career and the IFC into one, that would be a great place to start.
Yeah, absolutely. Well, I mean, again, thanks so much for, having me, on your podcast today. A little bit, background on myself, and then I'll go into IFC and what we're doing as part of the World Bank Group. But yes, I'm global sector lead for data center investments for IFC. And so I get involved in all of our transactions, both debt and equity financings in the data center sector globally. So I work very closely with my regional colleagues on these investments. And I also work very closely with some of the global clients, whether they're hyperscalers or multi-tenant data center operators, looking for ways that we can support them in expanding into emerging markets, into our markets globally. And I'm also a part of our global TMT business, where we're investing across the digital infrastructure value chain. And so we have a little over a $3 billion portfolio invested in data centers, towers, mobile operators, fiber, broadband, that's wholesale and retail connectivity. And we're also investing in media, media companies, as well as infotech, which is new and emerging technologies running over digital infrastructure. So yeah, in total, that's about a $3 billion business today for us, for IFC. And our global TMT business is a part of our global infrastructure business. So we have a $15 billion global infrastructure business where we're investing across various infrastructure segments. And so that includes, power, water, utilities, digital, municipalities, et cetera, et cetera. And so that's a little bit in terms of how we're organized. And I joined IFC about 10 years ago, and prior to joining IFC, I spent probably 10, 12 years investing in private equity in Africa. So I made several investments in private companies across the Africa region. One of them was a towers company called Eaton Towers, which was the third largest towers company across Africa, which was acquired by American Towers in 2019. And so that's a little bit about my background, really, which is private investments in emerging markets. But over the last 5 to 10 years, I spent quite much more time in digital infrastructure.
So maybe, Obinna, one question that comes to mind is when we think about infrastructure in the developing world, people would have easily, I think, come up with bridges and roads and power plants and the basic building blocks of an economy.
Yeah.
Can you talk about when data centers became sort of joined that community? Like when the IFC would have said, you know what, if a data center chooses to locate in Pakistan, that's a good thing, and we should consider investing in it, and here's how many jobs it'll create. Like, this is how we see it fitting into the development picture. I'm just kind of thinking that some members of our audience may be saying they didn't necessarily have data center in the let's build the developing world's infrastructure.
Yeah, no, those are great questions. So a couple of points there. First of all, the IFC, we are the private sector arm of the World Bank Group, right? So the World Bank Group is made up of three main arms. You've got the International Bank for Reconstruction and Development, or IBRD, which is essentially the arm of the World Bank Group that focuses on lending and advising to governments. So more of a public sector focus. Secondly, you've got the International Finance Corporation, or the IFC, which is focused on investing and lending into private sector companies and infrastructure projects in emerging markets globally. And then lastly, you have the MIGA, the Multilateral Investment Guarantee Agency, which provides guarantees for investors who are investing in emerging market projects and countries. So those are the three main arms of the World Bank Group. And we work very closely, and we're looking to work a lot more closely in our markets to eliminate poverty. And really, we have a significant focus now on increasing jobs, job creation in emerging markets globally. Now, on the private sector side, the way to think about us is that we are a combination of a private equity firm and essentially a lender, a commercial lender. We're the largest developmental finance institution globally. We've got a $100 billion balance sheet, and we're essentially a balance sheet investor. So we are providing equity and debt financing off of our balance sheet to private companies and infrastructure projects in emerging markets globally. And we're looking to earn a commercial return on either the debt side or the equity side, but every investment has to have a developmental impact. So that's the big difference between ourselves and what you would typically see as a typical sort of private equity, a financial investor, or a lender, potentially. Now, we've been investing actually for the past 65 years. So we started investing 65 years ago, but we started investing in digital infrastructure about 25 years ago. We were actually one of the first lenders and investors in the mobile operating, the MNO, mobile network operating sector. That's really where we started. So we were one of the first investors and lenders to these types of companies. And over time, we've sort of expanded our scope from mobile operators to fiber to towers and then to data centers. We actually started investing in data centers in 2005. So we started off as an equity investor in sort of small retail enterprise data center projects or companies. So we started off in Russia and then Ukraine, then expanded into India and then China and then South Africa. And most of these projects, we were providing equity to sort of sub 1 megawatt types of data center projects in these markets. And then in 2020, we expanded our strategy to become both an investor and a lender in wholesale and hyperscale data center projects. And so since 2020, we now have 10 investments in the data center sector globally. We have a little over 300 million invested in the sector. When you look at our portfolio, it's a diversified set of investments, across regions and across data center types. Some of our investee companies include Scala Data Centers in Brazil, which is one of the top hyperscale data center operators in the region. We're also investors in Kio Networks in Mexico, which is the largest co-location provider in that country. We are lenders and investors to Liquid Telecom and Wyok in the Africa region. And both of these companies are connectivity providers as well as data center operators across multiple countries in the Africa region. We're also lenders to Yonder Group in Malaysia. Yonder was recently acquired by Digital Bridge in that market. And the Yonder Malaysia transaction was very unique for us because that was our first AI data center project where we became a lender. And so that's but from a developmental perspective, just to come back to your question, when you think about how digital infrastructure is developing across emerging markets, it usually starts from mobile networks. Really, that's really been sort of the evolution. It starts from mobile networks, and over time, it has expanded into towers and fiber. One of the sort of the global trends that we've seen is that these a lot of the assets that were once considered to be strategic, once geographic or population coverage gets to a certain level, for example, once 70 or 80% geographic or population coverage is achieved in a market, certain assets that are owned by mobile operators are no longer considered to be strategic, and so they can actually be outsourced or they can be monetized, and the mobile operators can focus on their sort of core, their core value add, which is providing more value added services to their mobile customers. And so that's one of the waves that we saw in terms of telecom towers being outsourced or being sold off, and we're seeing that as well in data centers. I would say the difference in data centers is that especially since COVID, there's just been an explosion of data traffic and increased data demand in emerging markets. And I think when you look at the population demographics, for example, in Africa, more than 50% of the population is under 30 years old. And so you've got very young demographics. For example, same in India. You've got significant portions of the population that are under the age of 40. And these are very sort of mobile first types of demographics. They're using they're using all kinds of over-the-top platforms to communicate. And so there's just been this proliferation of data traffic, data demand. And as there's been this increase in subsea cables coming into emerging markets, it's brought down the pricing of data. And so there's just been this significant sort of increase in sort of the demand for data center infrastructure. So that's really part of what has been driving the need to finance these types of investments in our markets.
And I'm doing a throwback to way back when I was around some project financings in the emerging markets. It seemed like the IFC, if you could get them in to your project, it was really a nice signal to the rest of the market that this is a top-notch project.
Yeah.
But the IFC would not, as in terms of the capital stack, the IFC would take a small piece. They weren't huge pieces. Is that still the way to think about the IFC?
Yeah, that's a great question, and the short answer is yes. I mean, we started off really as a lender. So when you look at our balance sheet, 70% of our balance sheet is actually debt. So it's sort of medium to long-term debt financing that we're providing to companies and projects, and about 30% of our balance sheet is actually equity. So private equity types of investments that we're making. And historically, we started off as a lender, providing debt financing to companies and infrastructure projects. And then over time, our clients actually asked us to come on to join the capital stack as an equity investor. And so we were either co-investing with the sponsors, or we became a co-investor with other regional or potentially global private equity firms in these businesses. And so we do have a constraint in terms of, on the equity side, how much of an equity stake we'll take in any company or project. So we are limited to a 20% stake. So we never take anything more than 20%, in any business or in any project. And what that means is that, we are always a significant minority shareholder in these companies and in these projects. And what's important for us is to be very, very much aligned with the sponsors, the entrepreneurs, who started these businesses, or the financial sponsors who are looking to scale up or acquire these companies. It's very important for us to be aligned with them on the equity side. As a lender, we'll come in as we do have a constraint in terms of how much of an overall project we're willing to provide debt financing for, or how much of the capital stack we can take exposure to. But that's how we tend to think about our sort of position in the capital stack.
I think when we first met you, Obinna, it's because Substack is this wonderful world where lots of people are publishing lots of interesting things, and I think we've noticed around here, in any given week there's 20 or 30 Substack articles that we all are noticing or commenting on, and yours kept showing up as one that we all found really interesting. And it's different from week to week, but frequently you summarize all of the data center activity that's happening in the world. This one's happening in Virginia, this one's happening in pick a place. I mean, it's a real global survey. Would you mind talking about that, the work that goes into that, and maybe just try to give us a sense, because again, we end up being kind of US centric. Give us a sense of international or emerging market data center activity, and just where you see the hotspots, the real growth area, just the total numbers, because that's, without your Substack, it is definitely hard to keep up with.
Yeah, no, thanks so much for that. And one of the major sort of takeaways for us in the data center space is that it's really important to try to find ways to stay on top of what's going on in the sector globally, especially in the US. The data center sector is a global sector, and trends that start off in the US will trickle down into other parts of the world over time. It may take it may trickle down into certain markets, faster or sooner than others. But it is a global sector, and you do have this dynamic where you have 10 to 15 customers. 3 of them are US hyperscalers, which really these customers dominate demand for the data center sector globally, right? So and so just to give you some numbers, the US today is probably a 30 gigawatt market. in total. Northern Virginia is the largest data center market in the world, which is probably 3 to 4 gigawatts. When you compare that to other markets globally, the flat D markets of Europe, for example, these are, London, Amsterdam, Paris, Denmark, Frankfurt, these are all sort of 1 to 1.5 or around 1 gigawatt markets today, right? These are the biggest markets in Europe. The Northern Virginia market is pretty much almost as big as all of those markets combined, right? Just to give you a sense of scale. Now, if you expand further into other, emerging markets, for example, all of South America, like the largest market in South America today is Brazil. Brazil is about a 700 megawatt market. All of South America is around 1 gigawatt, right? Again, that's maybe 1/3 of Northern Virginia. All of Africa is about 500 megawatts. 500 megawatts, right? So all of Africa, we're talking about, 1.2 billion people, 500 megawatts. Half of that is South Africa. South Africa is about a 250 megawatt market today. And so that's maybe, compared to Northern Virginia, we're talking about, potentially 15%, right, of the current capacity in Northern Virginia. If you move into Asia, for example, India is a 1.2, 1.3 gigawatt market today. China is a couple gigawatts, maybe 3, 4 gigawatts, maybe more. There's a significant amount of oversupply in the Chinese market because the Chinese government has been really investing significantly in data center infrastructure over the past few years. Malaysia, for example, is a 250 megawatt market roughly today, but it has about a gigawatt in the pipeline that's coming online over the next 3 to 5 years. India has about another 2 to 3 gigawatts that's coming onto the pipeline over the next 2 to 3 years. And so you can see that, some of these markets in terms of emerging markets are relatively small compared to what we have here in the US. But when you look at their populations, you look at how fast their economies are growing, you can see that a lot of these markets are underinvested, and they are well positioned for future growth over the next 5 to 7 years. The Middle East is another region which is seeing a lot of growth. Saudi Arabia, the UAE, these markets today, they are in the sort of 200, 250 megawatt range. But again, they have significant development pipelines over the next 3 to 5 years where they're expecting at least 1 to 2 gigawatts to come online. So there's going to be a significant amount of expansion and growth in these emerging markets, but it will still be small compared to what we have in the U.S. in terms of the U.S. market. The numbers that we're hearing in the U.S. are that the U.S. hyperscalers are looking to add on somewhere between 30 to 50 gigawatts of data center capacity over the next 3 to 5 years. And this year, your colleague was mentioning some of the capex numbers. This year, the hyperscalers are on track to deploy about 400 billion in capex. And over the next 3 to 5 years, those numbers are likely going to increase to at least potentially $1 trillion in terms of capex that will be deployed in the data center sector globally. And so there's going to be a significant amount of capital that's going to be invested. A lot of that will be driven by the hyperscalers, and by some of these new model companies like OpenAI. But these are the majority of this investment will happen in the US, but there will be some of this that will be sort of allocated in Europe and emerging markets. But the long-term trend is that there should be significant growth in data center infrastructure in emerging markets for quite some time. Because these markets, at the end of the day, are still, depending on the region, 5 to 10 years behind where the US market is today.
Obinna, gosh, so many questions here. I think when people look at, let's say a gigawatt data center, it's the cost is pretty upfront. Everyone kind of understands it, but how do we estimate? What do you estimate is the infrastructure spend around that gigawatt? I mean, if you're going to go into Africa and say we're putting up a gigawatt, how much is all that supply chain, all the costs of infrastructure? Is that a 5, 10, 20 time increase versus the size of the data center? How does that all kind of play out? And when we hear $1 trillion in data center spend, does that include all that infrastructure build? That is it just, or is that on top of that as well?
Yeah, that's a great question, Mike. And look, there's a couple of things to think about. First of all, the rule of thumb that we tend to use is it costs about $10 to $12 million per megawatt to build data centers these days, right? 4 or 5 years ago, that range was in the $7 to $9 million per megawatt. 10 to 12 million is what we tend to see globally. In certain regions, for example, in the Africa region, it tends to be sort of the range we tend to see is 8 to 15 million. So it tends to be a little bit more expensive. And that reflects the fact that a lot of the inputs are being imported. It also reflects, potential delays in terms of getting things into the country, supply chain delays and things of that nature. In Asia, for example, the range tends to be a little bit lower, 7 to 9 million, because a lot of the inputs are more local, they're manufactured locally. And so it's going to depend on the region. But just in terms of when you think about the infrastructure, so the core and shell of the data center, the power, the water, the cooling, the MEP, all of those components, roughly we're seeing that it's about 10 to 12 million per megawatt. And the larger the data center project, the more the power component is going to be in the overall budget. So that's one kind of thing to think about. So, power can be anywhere from, let's say, 10 to 20% of the overall project cost of these projects. But once you start to get into, 100 megawatt and above types of projects, power becomes so much more important because essentially you start to look at, options to, develop a significant power asset for the data center project. And so when you get into the 1 gigawatt types of projects, I mean, what we're seeing is that, essentially there needs to be some sort of a power asset that's a part of that project. And that's really where a lot of this additional cost is coming from. The other thing to keep in mind when you're thinking about the cost of these projects is that, half of the project cost for these data centers is just this infrastructure. So core and shell, power, cooling, all of these sort of the MEP components. But the other half of it tends to be the chips, right? So the rule of thumb that we're hearing is that the chips essentially is going to be another 10 to 12 million per megawatt, right? Just rough rule of thumb. And and the chip numbers are increasing as I'm sure you're aware. When you look at these NVIDIA chips that are being released potentially every year now, right? And so when you think about a 1 gigawatt data center project, the numbers that we're hearing, it could be anywhere from 10 to 50 billion, and a big, at least 50% of that is going to be chips. And the other 50% of that is going to be essentially data center infrastructure, right? Now, your question was about Africa. So right now, we're not seeing 1 gigawatt types of projects in Africa today. That's just not happening, right? What is happening in Africa is in South Africa, we're seeing hyperscale and cloud types of projects. So we're seeing projects that are anywhere from 10 to 50 megawatts in size. In fact, Terraco, the largest data center operator in South Africa and in the Africa region, has announced a 100 megawatt project. So that's sort of the top end of the range in terms of what we're seeing in the Africa region. We're not really seeing 1 gigawatt campuses in emerging markets yet. Fast forward 3 to 5 years from now, that could be a possibility potentially in Asia, potentially in South America, in Brazil. So markets like Brazil, India, potentially Malaysia, those are the types of markets where, we could see gigawatt types of campuses because they have the right combination of land, renewable energy. They've got the technical capabilities to develop, to construct, and manage those types of facilities. So those are the markets where we could see that. right now we're seeing sort of 100, 200, 300 megawatt types of projects in those markets. So the US and some parts of Western Europe are the only markets globally where you're seeing sort of gigawatt types of campuses. And so that's just a little bit in terms of what we're seeing in the market.
And Obinna, maybe keeping with that line of discussion. So that's the upfront, costs. Kind of let's move to once it's an operation as an investor, as a lender. Maybe just talk about the economics and how those, how some of the variables change when you go from a 100 megawatt data center to some of the massive scale we're seeing. Just provide color on how you see the go forward return and operations of the facilities.
Yeah, look, it's a great question, and part of what we're seeing is that you've got two different types of data centers, right? You've got these hyperscale AI types of facilities, and then you have co-location, right? What we tend to see is that from a ramp up perspective, it's taking somewhere between 2 to 4 years to sort of build out these larger types of hyperscale AI types of campuses, and that's part of that's one of the trends that we're seeing. It's taking longer, right, to actually to build and to scale these projects up, and once they're scaled up, we're seeing that typically these facilities tend to have they tend to generate margins that are in the sort of 40 to 50% range. They tend to be on the lower end of the range for these larger scale types of projects, and that's because the customers in these facilities, hyperscalers, they have significant negotiating leverage, so they're able to secure significant amounts of capacity. Power tends to be a pass through for them, so they're not paying any margins on power, and so the margins on these types of the facilities that they are leasing out, they tend to be maybe in the 30 to 40% range, as opposed to co-location, where those customers, the facilities tend to be smaller. The customers are leasing up smaller amounts of space, and so the co-location operators are able to charge a little bit of margin on power, and because they're the customers are leasing smaller space, they're able to extract more value from that, and so we've seen margins that at the higher end of that range, that 40 to 50% range. And there's also a lot of other sort of value-added services that the co-location providers are able to provide, whether it's infrastructure as a service, potentially hand-holding the customers in terms of bringing their equipment into the data center, checking up on the equipment and things of that nature. So all of those additional services are helping co-location providers to achieve higher margins. But in these sort of larger AI hyperscale types of campuses, the customers there, essentially, they handle pretty much everything in those facilities on their own. They've got their own people. They sometimes they may even bring in their own power assets, depending on the location, depending on the market. And so as a result, the margins on those larger facilities, they're not as high. But because those facilities are so significant in size, they do command attractive multiples, right? So from a valuation perspective, we tend to see data center assets in the U.S. In developed markets are trading, for example, in the U.S. they're trading at somewhere around 25 times EBITDA, and we're seeing sort of M&A transactions occurring somewhere between 25 to 30 times EBITDA. So so that reflects the premium that's occurring there. In Asia, we tend to see data center assets trading somewhere between 18 to 20 times EBITDA. And so this is a sector where just given the margins, given the growth profile, given the scale, it's valuations are very sort of they're at an elevated level today. I think the 10-year average, when you look at the data center sector, the 10-year average of valuation multiples is around 17 times. So today, the sector is trading at a premium to that 10-year average.
And maybe, guys, just while we're on it, when you're talking about margins, what what do we mean when we say a margin on a data center? Are you talking about gross profit, or what? That number, what is that number? 30 or 40%?
That's a great question. So that's I'm referring to the EBITDA margins in this case. So when you
Wow.
look at,
I didn't want to ask that because I thought surely that's not how high it is, but that's pretty high.
it is. Yeah. And it's ultimately this is a fixed cost structure business. And so it is very capital intensive. And that it does provide, a significant barrier to entry. But once these assets have been leased up, and they're sort of north of 50-60% occupancy, a lot of that additional utilization is dropping down to the bottom line.
So, Bina, I was thinking, I referenced up front that the World Bank is so very influential, and it's come up, many times over the course of the years when we talk about energy, particularly in the developing world. And I was wondering about the World Bank's views of energy and how they show up in your business. So, for instance, when you're investing in a data center, for it to be approved as an IFC investment, do you care what the source of the power is? How do you think about the source of the power, and how does that affect your willingness to invest?
Yeah, those are great questions. And a couple of things I will say on the short answer is yes, we do care a lot about the source of the energy, and we are big proponents of renewable energy in emerging markets globally. And so we're one of the we were one of the first supporters of investing in solar energy in emerging markets globally. And we continue to support renewable energy projects in our markets globally. Where one of the other things that you'll see from our activity is we are a major investor in sustainable infrastructure, whether it's on the digital side or across infrastructure. It's very important for us to encourage our investee companies, our clients, to develop sustainable infrastructure, and that's whether it's on the data center side, for example, how much of the energy that is being supplied to the data center is from renewable sources. Typically we're looking to see at least 30 to 40% of the energy being supplied to the data center should be coming from renewable sources. Another example is we're looking to see data centers being developed with a PUE of 1.5 or lower. So globally, the global average for PUEs for data centers is about 1.6. Historically, that PUE was around 2, but going forward, we're looking to see that every data center that we invest in is being developed at a power utilization efficiency ratio of 1.5 or lower. And so these are just some examples of sustainable sort of KPIs that we look to identify and support on the data center side.
Would you mind, since we're all energy and power nerds, that PUE number, explain to us how that one works?
So typically the PUE ratio basically takes it's a ratio of all of the power that is being used by the data center or delivered to the data center divided by the power that's being used just by the IT equipment. So that is the ratio that gives you a sense of how efficient the data center is in terms of powering the IT equipment in the facility.
I see. Okay.
So the higher that ratio, essentially the less efficient the facility, and vice versa.
So one question for you, and this has been, I would say, reasonably dramatic change in the energy discussion in the U.S. over the last 5 years as energy transition gave way to data center, AI, et cetera. We're short power. As the focus of the conversation changed, natural gas really rose up the ranks quickly. And I'd probably say right now it's viewed as the number one way to power a data center, particularly if you're doing it soon. Has any of that dynamic started showing up in your world, which is you might have said a number of years ago, we really, really want to make sure it's of a certain flavor, but as time has changed and thinking has been revisited, is natural gas becoming a more desirable source of data center power for you?
It's a great question. And, the short answer would be that it's really a market by market type of analysis, right? So we have to look into individual markets to see what is the energy mix in that country. But at a high level, I would say that, we are, we're supportive of data centers that are being powered by natural gas, right? So we understand at the end of the day that, data centers will typically look to connect to the grid in their market and as sort of the primary source of energy. And then there will be, one or two backups, whether it's diesel or some form of renewable energy. And some countries have more or less access to natural gas, for example. And it is a trend in the data center sector where when it comes to energy to data centers, natural gas is becoming more of an option, right? So that's something that we have seen in the US, again, and that's going to be a trend that trickles down into our markets as well. It's not a big trend today. So most of the power that is being supplied to data centers in our markets tends to be either coming from, it's either grid, and that grid could be powered by renewables, it could be powered by coal, and so, some sort of mix there. But natural gas is something that we have seen in some of our markets.
The other big tension around data centers, and there's of course there's a global AI race. There's the need for power and the need for power soon. There's all these dynamics, but then the other one is the sense that all of this demand for power will be driving up the cost of power. And in your markets, you're talking about countries where, one of the reasons why they've been such a focus of our discussions is they are short energy and power. So how does that debate show up in your discussions, Obi, if you're talking about some of the developing countries you've mentioned? Is this seen as it's clearly seen as a positive for development, but is it seen as a positive for more power and therefore it's a good thing? Or is it seen as sometimes a competition for power in places which are already short power? Like how does that debate play out?
Yeah, Maynard, it's a really interesting question. I think, you're definitely hitting on a bigger sort of macro trend that we're seeing, which is the need to invest in more power infrastructure in our markets, right? The general trend that we tend to see across our markets is that there are, varying levels of issues with grid quality, and that is a major sort of challenge in a lot of our markets. A number of our markets also tend to be in a energy deficient position, right? And so we do have a few markets that actually have surplus energy. For example, especially when it comes to renewable energy, like Brazil has, potentially 3 to 4 gigawatts of renewable energy available, for that market. Kenya, for example, 60 to 70% of the power generated in Kenya is from renewable sources. Ethiopia is another country that has about 60, 70% of its energy coming from renewable sources. But most of the African markets are in an energy deficient position. And so there are a number of other sectors that are vying for increased energy investments in addition to the data center sector. The data center sector is still a small industry in the Africa region, compared to other sectors. So, you know, on our side, we have an initiative in the Africa region called M300, which is really focused on really channeling a lot more capital investment into electricity, the whole sort of electricity value chain, generation, transmission, distribution. That is going to be something that really unlocks a lot of growth, across the Africa region. But yeah, this is when we're looking at energy. When we're looking at energy to data centers, we usually will take a market by market view and really sort of analyze what are the dynamics within those markets in terms of and looking at the value chain in terms of generation, transmission, and distribution. Looking at the regulation. Is it possible, for example, for wheeling energy across different locations within a market? Is it possible to support on-site or versus off-site generation for data centers? And we're also looking at ways that we can support corporate PPAs for data centers, because one of the things that we've noticed is that when data centers get to a certain scale, they become more attractive to energy producers. So anything that is 20 megawatts and above tends to start to become attractive. And now we're starting to see in some of our markets 100 megawatt types of projects. So 4 or 5 years ago, our typical data center project was 2 to 4 megawatts. And today, when we look at our pipeline, our typical project is around 100 megawatts. And so at that size, these data center projects become attractive off-takers for IPP and other energy producers. And so we're looking at ways that we can support energy producers who want to develop energy specifically for data center projects, because they're now getting to that certain scale that makes economic sense for them.
Obinna, we pretty much talked about the U.S. and China. They seem to be leading, obviously, the AI race, the data center race. But I noticed I was looking at a Mitsubishi press release, and they're talking about their gas generation business growing 20% this year. It's probably going to grow 20% next year. And they really highlighted both the U.S., China, but also the Mideast. Maybe talk about what is going on with the Mideast. I mean, what is this for them? Is it a national security issue? Is it an opportunity issue? Where are they at right now? And are they accelerating? Where do you think they're going? Just kind of give us an idea of what's going on in the Middle East market.
Yeah, great question. Great question, Mike. Look, I mean, the way to think about this is that, when it comes to AI infrastructure, historically, there have been these sort of two bases. You've got the US and you've got China, right? And, clearly over the past 12, 18 months, we've seen significant, activity on the Chinese side with the DeepSeek models, the Qwen models. The Chinese hyperscalers have become more active. Alibaba is going to be investing $50 billion in AI infrastructure over the next 3 years. So it's really taking off. And strategically, China has decided that they really want to play a leading role when it comes to this infrastructure. And they don't want to have to depend on U.S. infrastructure, right? So there's going to be a significant capital that the Chinese government and Chinese private sector will be pouring into AI infrastructure, not just in China, but in markets globally. And you're seeing that when you look at the Chinese hyperscalers as they're expanding into other markets. So you've got those two sort of bases. But essentially what happens is that you've got this world where a lot of people have to decide, which infrastructure do I want to host on? Do I want to host on the US, or do I want to host on China, right? And so what's happening is the Middle East is essentially positioning itself as sort of a Switzerland of AI infrastructure, right? That you can come here and you can host your sovereign or your private sector workloads in our region, and you don't have to sort of be worried, or you don't have to be concerned potentially about basically running afoul of either one of these big giants. And so, over the past 12 months, you've seen a number of announcements of US hyperscalers, Chinese hyperscalers looking to develop multi-gigawatt campuses and infrastructure in the Middle East. And the Middle East, both the governments and their private sector. And because of the nature of the Middle East in terms of their governments there, they're just able to move very quickly. They're very much aligned in terms of their goal. And strategically, the way they seem to be looking at this is they want to, position themselves for a future where, oil and natural gas are on the decline, and they've sort of reallocated the profits from natural resources into essentially AI infrastructure. And that seems to be the direction of traffic. And it's interesting because the Middle East is geographically, well positioned between Europe, Africa, and Asia, right? And we've seen what has happened from a transportation perspective over the past 10, 20 years in terms of really sort of building up that transportation infrastructure in terms of Dubai and the UAE and the Emirates, and it's really become a major hub from a transportation perspective. And it looks like they're trying to replicate that from an AI perspective to a certain degree. And just given their relationships with multiple regions, given their proximity to multiple regions, and given the sort of the latency advantage that they potentially can have connecting subsea cables to all these different regions, there could be a scenario where they become an alternative to co-locating either in the U.S. or in China for a number of different private sector companies or potentially sovereigns. So that could really be a very interesting dynamic, and we're watching that as well.
That's really fascinating. I was wondering, maybe take a couple steps back as you look at the next handful of years. What are one or two of your most interesting kind of emerging trends or themes? It could be this Middle East dynamic, U.S. versus China. I noticed in your Substack this weekend, the big private credit deal on the Meta campus was highlighted. But what are a couple of your favorite trends or themes to watch?
Yeah, that's a great question. That's a great question. And I mean, look, I would say that one of the big themes is that no one model will rule them all, right? I think there's this sort of sense that it's a zero-sum game to a certain degree when it comes to models, right? And actually, I think that what we're going to see is that it's not necessarily a zero-sum game. There will be different types of models. So there will be large models like ChatGPT. There will be medium and small size models. There will be country level models. There will be all different types of models. And so there won't be one model that rules them all. We will be using different types of models. And what that means is that there's going to be a need for continuous training. We will always be training these models, right? We're going to be training models forever. But the training may not be as intense. So instead of spending 12 months or 18 months training a model, maybe the training time goes down to 6 months or 5 months or 4 months. But we will always have these inference use cases. We will always be interacting with these models. And the inference workload is just going to be, I think, it's going to be consistent, because as you have more models, there's just going to be more increased usage of those models by consumers, by enterprises, by governments. And so I think that's going to be sort of one major trend that we're going to see. I do think that the other trend that we will see is that there will be increased sort of debt financing for AI data center projects in general. Typically, we're seeing somewhere between 50 to 70% leverage that's being utilized to finance these projects. And just given the numbers that we're hearing, at least $1 trillion potentially in capex over the next few years, there's going to be a need for a lot more debt financing, and that's going to open the opportunity for new sort of investors to come in to support data center development, and so private credit is going to be sort of a welcome beneficiary of that trend. So those would be sort of the two sort of macro trends that come to mind.
Well, Obinna, you've been really great generous with your time. We found this fascinating. I'll speak for all of us. We knew we would. As a last thought for our audience, when you think about this global AI data center trend, and then you think about the emerging markets, does this, it seems like you could make a case that these trends will be very positive for the emerging markets and lots of development will happen on the backs of these trends. On the other hand, it seems like you could also make a case that this will cause a further divide in the world between who has all of this and who has less of it. You know, when you went around the world with the gigawatt numbers, that was sort of on display. So do you just, I know it's super simplistic, but as a proponent and advocate and someone who helps the emerging markets, are you excited about what this does for the emerging world, or are you concerned?
Yeah, Maynard, that's a great question. And look, the short answer would be that it would be a little bit of both, right? So we're excited in terms of the opportunity to support, shared infrastructure, passive infrastructure that will, lead to increased connectivity, improved connectivity. It's going to lead to, reduce costs in terms of data sort of traffic. It's going to lead to, supporting more sustainable infrastructure in these markets. It's going to lead to economic growth, creating jobs, both direct jobs and indirect jobs. So we see a lot of positives from the growth of AI and data center infrastructure in emerging markets globally. And then in terms of concerns, we are definitely, we remain vigilant in terms of the impact that this infrastructure is going to have on these economies, especially in the environment, in terms of, making sure that this is going to be sustainable infrastructure, that it's, that as these projects grow in size, that they're able to source more renewable energy. I mean, that's really going to be critical. I think that's going to be one of the most important things, really, is ensuring that, as this the sector, grows, that the expertise that comes from the U.S., that's sort of trickling down into these markets, so that these markets are benefiting from that technology expertise, but that the infrastructure is being built in a way that's sustainable for these environments in these countries.
Well, I know this could be a whole nother show, but when we attended the World Nuclear Symposium in London, it was big news that the World Bank had said, I'll get the language wrong, but basically the World Bank came out and said, we're now a proponent of nuclear.
Yeah.
And so it's fascinating to watch how these things are getting rethought. And I know that was a big announcement. It was the first time, I think, since 1959 that the World Bank had that view. So, well, Obinna, thank you so much. We are going to encourage all our viewers and listeners, please subscribe to his Substack. It's quite good. We're always tuning into it. And Obinna, we're delighted to have made a new friend. And please come see us in Houston. We'll come see you in the DC area.
Please do. Please do.
Fantastic. Thanks, everybody.